it back into the vessel which is slightly younger. So when you look at that math, right, we believe we are being conservative in the way we are investing this capital. While we keep exploring the way to deploy our capital at these price levels, we are a bit cautious in terms of investing and going net long into the business.
See, the question is the base capital investment remains $60 million in what we are doing and versus adding one more ship directly. Okay. But my IRR will be much more front-ended if I add 3 ships or I have 3 ships versus 2, because my day rates or the cash flows will be...
Himanshu, sorry to interrupt, but I've got your point. So where we are adding on the 1 ship of capacity upfront, and you're saying, why don't you just add that 1 ship capacity instead of saying that you're going to move out of 2 old ships and move into 2 modern, less old ships, let's say.
Yeah, the IRRs, how does it impact?
Yeah.
And I found the IRRs better.
Yeah, the thing is, you might, if you price in, let's say, so what you're saying is, why don't you just buy outright a modern product tanker instead of doing these switches? Yeah. The issue with doing an outright purchase is then you need a very strong market in order to justify it, because you know where the asset prices are. The asset prices are at their highest level since 2008. So you need then to price in a very strong market for the next 3 to 4 years in order to justify it. And what we're doing is simply saying that we don't know if that will happen, and we can't bet on that happening. And therefore we are saying, in this high part of the market, we are trying to limit the amount of capital that we put to work. We are maintaining our market position. We are ensuring that those couple of vessels which are getting towards being overaged and cannot be traded freely in the international market, we move out of those and maintain our position in the international market with some additional capital, but reducing the amount of capital which could potentially not make a very high return or potentially not meet our target return. It's like, let me just give an analogy in the market. In the stock market, you can choose to say, I'm going to put new money to work in this market, or you can say, I'm going to switch out of one of the things where I've made money and put it into another. I'm just moving my money from one to the other. So we're just trying to limit the amount of investment we make in the high part of the cycle.
See, I don't agree to the stock market analogy, because here you are getting 3 rent yielding assets. Okay. Stock market is not a rent yielding asset. Okay. So there is one point of difference in that analogy. Okay. And the second is, if the base assumption we are not ready to invest incremental because the markets are high and that is the assumption we'll need to make. But then if that is the whole thought process, then why do we renew also the old ship to new? Because the base capital you are putting is 30 from the older vessels, what you sold, and 30 for the new vessel, what you put in, which is $60 million. Okay. So I hope you are getting from where I am coming. Okay. And with the 3 revenue days you get versus 2. And if we are not ready to take the risk of putting incremental money, but then we should not, I think there is some point of difference of opinion here.
So one of the things is just let's talk about the net long position, right, where you're just buying a ship outright. The thing is that we should not get overly carried away with the current yield, right? Because while today the markets could be very strong, they can be very weak in the future. And then what looks good on paper today could eventually look very bad in the long term, right? It is possible. It's not necessary, but it is possible. And we always play on probabilities. And today, with the way the markets are, the price levels at which they are, you need the market to be strong for a longer period of time to make this project justified. However, on the switching, right? Yes, okay, that is a fair point. That then why even do the switch? But like I mentioned earlier in the conversation, let us just take a very crude example. Okay, very crude example. Let's say you're willing to pay 100 rupees for a ship, right? And today, because of the way the market is, it's at 150. You are selling that asset and capturing that 50 premium, which you were which you normally would not have gotten unless the market was this strong. And then you go buy a younger ship, right, which is, let's say, priced at 200. That's also priced at a higher price of 250. So that also has a premium. So you're recycling the premium from one ship to the other. So you're being more conservative. What is your other next best option? Your next best option is to lose the capacity entirely. And then what happens is that if the market does remain stronger for longer, then you don't have a ship to take advantage of that. Also, on another issue, as a shipping company, you need to maintain a certain level of exposure in the market because you have charters, customers, employees, you have a whole system to keep running. So you can't beyond a point, or you may not want to beyond a point, shrink your capacity and your market presence. So you have to balance between the two. It does not need to be a binary outcome where you say, okay, fine, if you're not willing to add additional ships, then why not lose all your current existing capacity?
No, see, there is a third option, okay, which you are not talking about. Let the older ships run in good, and in these times, okay, when the capacity is scarce, the ships can be run for another 2-3 years, okay. And the risk capital, which I am saying, is remains 30. Okay, it does not go to 60.
No, I'll stop you there. That assumption that you are working under is not correct. In the old, what you are describing was very true in 2004 to 8. We ourselves ran 25-year-old ships in the international market.
Correct.
It is not valid today, unfortunately, or maybe fortunately. There are a lot of trades which are just not available to an older ship. Say a 20-year-old MR or 20 or 21-year-old MR tanker, irrespective of the condition, and we run very good ships. Irrespective of the condition, all they look at is what was the date of build of the ship. If it has crossed so-and-so age, it is not acceptable at this terminal, or it is not acceptable to me to carry my cargo. That is one change. What you are saying was very true in 2004 to 8. The market is different today, and we will actually not be able to participate in a lot of trades with overage ships. I agree with you. In a hot market, the best ship to have is the oldest ship, because your EBITDA, and you just take the MR rate last year or last 2 years, has been probably $33,000-$34,000 per day. And if you knock off if you take your EBITDA, you produce $18 million of EBITDA. Nothing could have been better than having a 20-year-old ship 2 years ago, which was worth maybe $10-12 million. No investment could have been better than that. Unfortunately, those are the numbers on an Excel sheet. They don't work because a lot of the customers and a lot of the trades do not accept 20-year plus ships.
And what would be the strategy on product tankers also for us? Because would we also like to replicate the MR strategy on product tankers, where also the age is...
The MR tankers are the product tankers.
Sorry, did you mean...
Oh, sorry, the crude carriers. Okay. I made a wrong statement.
Yeah. No, so we will look at that also, because like one of the other analysts asked that, we do have fewer crude tankers and product tankers, and beyond the point, we wouldn't want to lose that capacity as well. So we will explore switching those as well, but we still have some time before we need to make that decision.
Okay. And one question on this.
May I request you to come back to you, please?
One last
we have
question.
several. Go ahead, sir.
You see this Great Drill Chetna, the cancellation of order, what has happened, is there any minimum payment or cancellation fee
It's
which
not a
you will
cancellation
get?
sorry. It's not a cancellation of a contract or an order. The tender got cancelled before it was awarded. It was a tender which was under processing, which has got cancelled and is not being awarded.
She is currently on contract. For the next contract, that tender got cancelled.
Okay. Okay, I'll join back in the queue. Thanks.
Thank you.
Oh, thank you.
Thank you. We'll take our next question from Dhruv Agarwal from Niveshaay. Please go ahead.
Yeah. Good evening, sir. I'm audible?
Can you be a little louder, please?
Yeah. Is it better, ma'am?
Yes,
Yeah.
please go ahead.
Yeah. Sir, I have just one question. Sir, how do you see the demand outlook in the offshore segment on the logistic and the drilling side, sir?
Yeah. So the demand outlook is fine for the vessels we mentioned earlier. The demand outlook is fine for the vessels. Even for the drilling rigs, except for this one event which has happened, and because that is such a large customer, not for us, but in the market, they were in the process of having 90 rigs, which is a very large proportion of the market. There are 90 jackup rigs. Otherwise, the sentiment was quite strong. The sentiment for the vessels continues to be very strong. The rigs, as somebody previously said, the mood in the market might not be as positive as it was for the last year and a half. But again, that's something which changed with these actions that could turn around also.
And
But
sir,
sentiment continues to be positive because of what's happening with oil prices. Oil prices have remained pretty high, and E&P activity also continues to be very strong, exploration production activity offshore.
okay. And sir, on the logistics side, how is it?
It's running perfectly fine. The businesses are getting awarded at much higher levels than they were running at previously. So sentiment is strong in the offshore logistics business. The vessels are running well, are getting priced at very strong rates.
Okay. Thank you so much, sir.
Thank you.
Thank you. We'll take our next question from Abhishek Nigam from Motilal Oswal. Please go ahead. Mr. Nigam, can you please unmute and go ahead with your question?
Yeah. Hi, everyone. Congratulations on a very good set of results. Hello. Yeah. So just on the delivery schedule for product tankers, do you have any visibility? Because that number now, the order book number is 15% odd. So, I mean, I'm just wondering if that segment is running into some trouble. So that's my first question.
So just one thing there, nuance which you have to see in the product tanker order book. A very large part of the product tanker order book is LR2s. LR2s, and while we talk about the aging fleet, etc., typically LR2s beyond a certain age tend to move, and you know that LR2s are basically Aframax sized tankers, which have ability to carry clean product, petroleum products. Typically, after a certain age, LR2s move into the Aframax trade. So they switch from being product tankers to crude tankers. And a very large part of the order book is LR2s. Even the ships which are on order, typically owners, the cost to creating that option to trade as an LR2 is not very high. It's $1.5 to $2 million on a now an Aframax tanker probably costs $70 million to build. So typically people will just put that option onto their ships and build their ships as LR2s, but they can even trade them in the crude tanker market. So a significant part of the product tanker order book is LR2s and could easily move into the crude tanker market. So that's something to keep in mind.
Okay. I think that helps. And offshore is a pretty good show this quarter. So is this number sustainable, or the other way to ask is there any one-off over there which may not get repeated?
There's one-off which was 12-13 crores, which was a reversal of an impairment which we had taken earlier on one of the vessels. But otherwise, the significant event is the repricing of the Great Charu, which where the headline rate went up by about $30,000 a day. So that was the one event. But yes, I think I mentioned earlier that the business is coming back to profitability with all the pricings that have happened in the last year and a half.
Fair enough. And just one last question from me. So on this issue of rig suspensions in the Middle East, my understanding was that on for a lot of those contracts, basically they were suspended for a year, and mobilizing the rig out of Middle East really it takes a while, especially if you have to go to say North America or elsewhere if you have to come to Asia. And so, practically speaking, the incentive is not very high for those guys to move out because there's a big mobilization cost involved, and then 1 year later you would still end up getting employed in the Middle East. And everybody wants to be in the Middle East because that is really the center of action in oil. So, are you seeing sort of jackup rigs moving out, or is it more like people are sort of more in a wait and watch mode for now?
Yeah, so I saw at least one rig, if I recall right, being fixed into Egypt, which is it's still the Middle East.
Okay.
What we haven't followed what's happening with the specific rigs, but what you say is correct, that people will tend to stay here unless they land a contract. They're not going to move the rigs into another region on speculation. So if they bid and they get a contract, they could move, but they're not going to move on speculation. That's not the way the business works. So they will probably like to stay here for some time and keep their position in the, we could call it the queue. It's not really a queue, but to just say that we are still hanging around here waiting for the contract. So if the point you're making is it's not likely to result in a glut of rigs in other markets,
Yes.
you're right.
Yes.
It is unlikely to result in a glut of rigs.
Okay, fair enough. Thank you so much. That's it from me.
Thank you.
Thank you. We'll take our next question from Kunal Tokas from Fair Value Capital. Please go ahead.
Hello, sir. Am I audible? Yeah.
Yes, not very clear though.
What about now?
No, still not clear.
Hello?
Oh.
No, Mr. Tokas.
And now?
A little bit better. Please, let's see if we can hear your question.
I'll try, sir, and if it is not better, then you can skip the question.
Yeah.
My question is about the LPG carriers and especially the strong order book that we see here. So the strong order book coupled with the relatively young age of these vessels, and given how prone the shipping industry is to the capital cycle, do you foresee any risk of the capital cycle turning, especially in the VLGC vessels?
Yeah. Yes, it is a possibility. So just to give you an update on our business itself, typically our vessels have run on time charters. Our LPG carriers have run on time charters. We have recently repriced 2 of our vessels on time charter itself, on 2-year time charters, and the repricing has happened at a significantly higher rate than previous. So they are at about 40% higher than the previous rate. So these 2 vessels will come off contract in the coming 2 to 3 months and will go on to the higher rates. We're not expressing necessarily a view on what could happen to the market. What we're saying is that our pricing on the contracts has improved significantly. But what you're mentioning about an overbuilding, I think what you're hinting at is that there could be an overbuilding of LPG ships. It is possible. It could happen where we don't know what could happen and what could trigger a drop or a change in the demand-supply balance for LPG ships. But it is possible because that happens in shipping cycles, especially very strong shipping cycles.
But we have also seen in the past that sometimes the order book for LPG has been strong, but the demand has been stronger and the market has sustained longer than we expected. But at least from our own position, we have contracted our VLGC fleet.
Fair enough, sir. And my second and last question was, in response to one of the questions, you mentioned that you can easily be 5x the size that you are without tempting the overall balance of the market. So what stops us from doing that? And is it fair to assume that you will grow much faster in terms of your capacity, not necessarily the revenues, but in terms of your capacity when the market is in a downturn? Because then the asset prices will be much more attractive to you.
Yeah, good question. Yes, the answer to your last question is yes. It is our intention, and we have the financial capacity and the balance sheet as well, to grow significantly in the next downturn when the prices are right. So yes, that is our intention. There is a lot of room to grow, and what I mentioned, we have 6 crude tankers currently. 5 years ago, we had 12 crude tankers. Several of them were old and had to go. So we were twice the size that we are currently just 5 years ago. And we can easily, as I said, we can easily grow to 5 times the size without really causing a dent or becoming too big. So it can happen, and as you rightly identified, it is our intention at the next opportune market, we will look to expand significantly.
Okay, sir, understood. And thank you very much for the detailed presentation that you bring out each quarter. Thank you.
Thank you so much.
Thank you. We'll take some text questions. We have a text question from Shivan Sarvaya from Humiviction Investment Advisors LLP. The first question is, could you please provide the reasons for the increase in other income? What constitutes other income? And the second question is, as the markets tighten in the offshore segment, how has the cost of operating a rig or vessel moved over the last 2-3 years? Could you please quantify?
Yeah, thank you for the question, Shivan. The other income is typically treasury income. Most of it is treasury income. As you know, we have very significant cash balances which have built up a lot in the last 2 years as the markets have been very strong. What has also happened is that a large part of our money is kept in dollars, and you know what has happened to dollar interest rates over the last year and a half. Basically, what has happened is that we have more dollars, and we have the equivalent of $650 million currently, including the rupees and the dollars. So all of that goes into other income.
And on the second question, I think maybe costs have gone up by 20-30% over the past 2-3 years. You know, as the markets have tightened, the demand for the crew on board the rigs and the offshore vessels has increased. Along with it, even general inflation in spare parts, stores, etc. for the vessels and the rigs have increased. We go on
Thank
to the
you.
next question.
The next question is from Narendra Kutia from Robo Capital. What kind of revenue and margins are we looking at in the next 2 years?
Yeah, as I mentioned earlier, we do not forecast and we don't give guidance on revenue and margins. A large part of our capacity is operating in the spot market, especially in shipping, and we do not give guidance on either revenue or margins or profits.
Thank you. The next text question is from Jayant Ugra, and the next question is from Jinit Savla. Instead of paying out dividends, why can't we move towards share buybacks?
We don't see the relationship really between dividends and share buybacks. Our buybacks are done as part of capital allocation. We look at buyback as the ability to buy into our business at a very cheap price whenever those opportunities are available. It is not a replacement for dividend. Dividends are part of our cash flows that we are returning to our shareholders. So we don't look at it as a buyback as a replacement for a dividend.
Thank you. The next question is from Rajesh Agarwal from Money.org. Ship bought and sold, are we net long from previous year 2023 to 24 to 2024-25 in terms of revenue and absolute EBITDA after normalization in Panama Canal and Suez Canal, will the overall transit time increase?
So I think there are several questions here.
Several questions merged together.
Our capacity is more or less the same as it was for FY24-25 as it stands today, is more or less the same as it was in FY23-24. That's the first one. In terms of revenue and absolute EBITDA, we don't know. As I said, we don't forecast revenue and EBITDA because the rates are very volatile and a large part of our capacity is in the spot market. But yeah.
The third point.
But if you have normalization in Panama Canal and Suez Canal, the transit time will reduce and reduce demand for the 1 mile demand for ships.
But Panama Canal mainly has an impact on the gas carriers, while the Suez Canal mainly has an impact on the product tankers. So it depends on, and it also depends to the level at which it is reversed. Because, is it reversing, because there's been a lot of disruption because of the changes in the movement through the canal. Yeah, okay. Should we go to the next?
Thank you. Yes. We have a question from Harsh Chandalia, an individual investor. Could you please throw some light on shadow fleet in the crude tanker segment and impact of recent US sanctions on crude tanker segment in FY25? Is the 18% aged fleet in crude tanker segment inclusive of shadow fleet?
Yes. So the 18% includes the crude, the shadow tanker fleet. What is the first question?
What is the impact of the crude tanker, the US sanctions? Very small. Yeah, the US sanctions that we have seen are for, I think, some small operators. So far, we don't see what impact they have because some of these ships just move from one operator to the other. I don't think they have been very widespread, these sanctions.
Those are referring to the individual ship sanctions.
That's right.
Yeah. But the US has also been tightening the checks and balances because you can carry Russian crude if you're below the price cap. But some operators, especially the shadow tanker fleet, were carrying crude over the price cap. So the US government has been trying to make it tougher. So a lot of players who have been trying to carry the Russian crude, there has been some impact with reduced Russian loadings.
Thank you. I'll read the next text question from Rajesh Khater, an individual investor. Does the normalized financials exclude the profit from sale of ships? And second question is, please tell more about the subsidiary in GIFT City.
Yeah. So yes, the normalized financials, no, they do not exclude. Normalized financials include profit from sale of ships. We believe that this is a part of our normal business. The subsidiary in GIFT City is in the process of being set up. It is not yet operational. The intention is to do some shipping business through that subsidiary.
Thank you. The next question is from Darshan Patel, an individual investor. The first question is, since the tender for the offshore rig stands cancelled at the onset of monsoon season, how will it affect the operation of that particular rig? And the second question is, where do you project the price of bunker oil for the next few quarters as compared to previous few quarters?
Yeah, the operation of the rig continues as before. The current contract continues. And
we are likely, so generally we have seen that ONGC tends to extend the rig during the monsoon. We will know that in some time whether they're going to redeliver it in the early part or the end of the monsoon. Of course, we have to work on the next contract for the rig. And on the bunker prices, we actually do not do a forecast of where the prices are going to land up over the next few quarters.
Thank you. We'll take the live questions now. We have a question from Devesh Jawar, an individual investor. Please go ahead. Mr. Jawar?
Yeah. Congratulations, sir, on great set of numbers. My question is regarding the rates and decision of fixing the vessel on the time charter. So the rates currently, as we are speaking, I think they are probably higher than the last quarter's average. So, would the management take a call on placing some product tankers on time charter, some part of the fleet on time charter? And secondly is regarding the